Good afternoon, ladies and gentlemen. I welcome you all to the Q1 FY23 post earnings conference call of United Drilling Tools Limited. Today, from the management, we have with us Mr. Pramod Kumar Gupta, Chairman and Managing Director, Dr. Kunal Gupta, Executive Director, and Mr. Mukesh Mehta, Chief Financial Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may exemplify our judgment and further expectations concerning the developments in the business. These forward-looking statements involve risks and uncertainties that may cause actual development and results to differ materially from our expectations. Also, this is a reminder that this call is being recorded. I would now request the management to kindly brief the participants a bit about the business, the performance for the current quarter, post which we can open the floor for Q&A. Over to you, sir.
Good afternoon to all the participants, and we thank you for your time and interest in UDTL. I would also like to thank Captify Consulting and Mr. Vinay for organizing this event. We believe that you all would have preliminary understanding about our business and operations. A brief about United Drilling Tools is that UDT is a global manufacturer of high quality precision engineering products in upstream and oil and gas exploration. It is a single manufacturer of several oil drilling items such as wireline winches, stabilizers, and large OD multi-start connectors in India. It's a solution provider with presence in downhole tools, wireline, well service equipment, and gas lift equipment. This leads to a 60% market share in the upstream drilling tools and equipment market in India. We have a good pedigree management with 4 decades of deep industry experience of serving in the oil exploration and production sector. The company has 4 state-of-the-art and technology-focused manufacturing facilities across Noida and Gujarat. The company has an integrated value chain from being a stabilizer manufacturer to manufacturing various oilfield drilling and production equipment. Key business highlights are development of new product lines such as side pocket mandrels, swift connectors, and links connectors are under process, which have demand in Indian and overseas market. We are registering into more and more countries and are getting repeated orders from Vietnam and Egypt. Also, we have registered and gotten orders from new companies like Shelf Drilling and Gulfil. Due to COVID-19 pandemic, Indian PSUs like ONGC were not able to drill complete number of wells that were planned by them in the last 2 years. This led to them having surplus quantity in inventory stock, which they are utilizing now, and due to which they have not procured material in this quarter and have deferred their procurement plan till the next quarter. This is a temporary phase, as ONGC and Government of India both have announced in the past that they are trying to increase the domestic production in oil and gas that will lead to drilling of more wells. We have sold products like casing, stabilizer, and gas lift equipment to various domestic and global customers, which is 16% more than the Q1 FY21-22. We currently have orders in hand 70 crores, and in which export is around 10 to 12%. We have submitted 200 crores approximately bid, and in which export is about 20%. Local approvals for our new upcoming project in Gujarat near Mudra Port have been done, and it is in construction phase. The future business strategies include increasing registration in international markets, adding footprint in Southeast Asia, Middle East, Russia, and South America, scaling capacities of all product lines, increase product range via organic and inorganic routes, reduce cost of production, and enhance revenue potential and profit margins. Now I would ask Mukesh Mehta ji to please kindly go through the results of Q1 FY22-23. Mehta ji, you are on mute, sir.
Thank you, sir. Good afternoon, everyone. So turnover in the Q1 23 is 36.99, which is 16% more than Q1 FY22. And whereas EBITDA is 5.44 and EBITDA margin is 14.70. Whereas in Q1 FY22, it was 20.20 and EBITDA margin was 63.60. Profit before tax is in the current quarter 4.42 and in the last Q1 FY22, it was 19.33. And PAT is 3.12 in Q1 FY23, whereas in the Q1 FY22, it was 14.22. PAT margin is 8.3%, 8.43% in Q1 23, and 44.46 was in Q1 22. EPS in Q1 23 is 1.54, whereas in Q1 22 it was 6.95. So there is a dent on our margin. The reason for the reduction in the margin is due to the raw material which we bought in the last year at high price, and the product mix also. Product mix in this quarter we sold the products which are low margin products and high material cost, whereas in the Q1 FY22 we sold high margin products which are winches and connectors. Therefore, the profit was more in that year. So fixed overheads also have been increased by 2 crore in the Q1 FY23, comparing Q1 of FY22. So I transfer to Dr. Kanal Gupta for question answer session.
Thank you, Mr. Mehta. Before the question answer session, I'd like to add a few more points. That as Mr. Mehta had said, that the profits have been reduced since raw material brought in the last year was at higher price. In this quarter, the products that were sold were of low margin profits like gas lift equipment, stabilizers, and casing pipes. There was an increase in raw material price of approximately 30%. Due to this, the impact on our profit was 15%. To establish ourselves in the export market, we had to somewhere compromise with our profit margins in comparison to the profit margins in domestic market, as we are a new company in them. This will get better once we get established. Further, we have to give some percentage of commission to our overseas sales representative in that. The fixed overheads in Q1 FY22-23 has been increased by 2 crores, which has impacted our margins by approximately 6% in this quarter compared to the last year quarter Q1. We need to hold higher inventory of raw materials since private and export orders have shorter cycle delivery periods of 3 to 4 weeks versus the domestic PSU orders, which are about 4 to 6 months. We are sitting on high levels of inventory due to the lengthened delivery periods of steel suppliers, which we saw in the past, and which was of higher price, whereas the new contract of private and global companies received or executed at low steel price. The revenue breakup was 75% was approximately casing pipe, 10% was approximately gas lift valves and mandrels, and 15% was stabilizer for the Q1 FY22-23. For only Indian PSU orders, we have an understanding with the steel suppliers of a back-to-back firm prices. While this issue is expected to impact our margins for one more quarter, we are in talks with professionals to evaluate options for hedging or steel inventory to mitigate volatilities on account of steel price. We have also seen that the same thing is also impacting other players who are competing with us in this business. I would now request Vinayji to start the question answer round. Please. Thank you, sir.
Thank you, Kanal. Anyone who wishes to ask a question may use the option of raise hand. Alternatively, you may unmute and ask your question. Saket ji, please go ahead.
Namaskar, Kanal sir.
Namaskar.
So firstly, would like to understand as being explained to us, we would like to understand the continuity of the factors that will lead to these margins being the order of the day for आने वाले quarter के लिए, माने as being concluded by the company person, it has been stated that even going forward also these will be the new margin set because of we trying to get our foot in the export market. So if you could delve more into it, what kind of operating environment are we looking into? And sir, when we had this conversation in the fourth quarter, if I'm correct me there, we were not briefed about the product profile changing in just in one quarter itself. And we were of the view that the margins would be in the same vicinity as has been the March quarter. So where has been the anomaly, and how have things changed in just one quarter? So correct me, sir, where I'm making a wrong assumption.
Can you, Sakesh, can you please repeat your question, sir, again?
Sir, my question is regarding the dip in margins, which you have elaborated that because of our getting our foot or getting ourselves recognized in the export market, we need to sacrifice the margin, build our brand. So, and also your point that this is going to continue for at least for one more quarter. So we would like to understand firstly the operating environment for the company in the product profile, and since last quarter conversation, the inventory buildup was there, but we were the community was not informed about the change in the product mix or that there would be a significant change in the margin profile. So where has been that disconnect that has happened, sir? And this, I think, so this quarter also there is a built-up in inventory. So what could be the impact going ahead, sir? These are my points, sir.
So the first question that you have asked, sir, see, till last year, till before last to last year, we were selling mostly to the domestic PSU market. And from last to last year, it was around 2%, which was to private and export. Now, last year, we had done around 5 to 6%. We has increased. And similarly, this year also, we are hoping that around 10 to 15% of our total revenue will be through export and private companies. Coming back to the point that the difference is that Oil India and ONGC are the major customers that were there before. And as I stated, that because there were in last 2 years, they were not able to drill the total number of wells which was planned, and they had inventory and stock. So this quarter and next quarter, they have stock for that already available, and they are utilizing that stock. Now, post that, they will not have stock for the casing pipe with connectors and the products that we sell. So now they will be requiring to procure that, which would affect that in the EBITDA margins and the margins we will see improving in after the next quarter. For export also, see, what has happened is that we had bought the raw material in last year from January to March, because the steel price, the steel that we were getting, the delivery was around 7 to 10 months. And because of that, and the orders that we had to execute, which usually the delivery period is for either PSUs or to the private and export is, for private and export is 3 to 4 weeks. And for PSUs, it's 4 to 5 months. So we had to keep certain amount in stock so that we can curtail to any orders which will come through that. So to answer your first question, sir, that is a difference which has happened between the last year quarter Q4 and Q1 and Q2 right now. But we are hopeful that this is going to improve in the Q3 and Q4 results.
Sir, when we are procuring order from our customers, there is a back-to-back arrangement of raw material, or there is a lag effect? Do you want to say that there is an inventory markdown because of the correction in steel prices that has resulted in lower margins?
Mehtaji, will you like to answer that, sir?
There is a back-to-back arrangement, but in the last year, there was some volatility of the raw material. lead time of the raw material was also increased. So very difficult to get the order. So we bought the inventory, and otherwise we have the back-to-back firm price of the raw material, and sometimes we have the escrow arrangement with the vendors also.
Mehta, may I answer that? Huh?
Yes.
Yeah. Okay. Sir, we have two type of customers. We have PSU customers like ONGC and Oil India, where they give us about 6 to 8 months time to supply the material. So in those cases, we have back-to-back arrangements with our steel suppliers. But in case of private customers and export customers, we don't have that arrangement. So in order to cater them, we have to keep inventory also and supply that, without that, facility of hedging or back-to-back arrangement. So yeah, so that is one of the reason why our prices, we have to take a hit, in this particular quarter with regard to our profits. Does that answer your question, or do I need to?
Sir, in absolute number, sir, can you give that number that would have impacted had this not been an inventory write down? When steel prices has corrected, we procured it earlier at the peak of the cycle. That this is what the understanding is. So can you give the effect of the inventory markdown that has happened?
I would say, I think it was around 15%, Mehtaji, you were saying, huh?
Yes, the impact of our profit was 15%.
It has impacted our profit about 15%, right?
Yeah, 50% is the material cost, and 30% was the increase in the raw materials. So that makes about 15% impact on our EBITDA margin. So 15% is reduced, and 6% by overheads, which have been increased in Q1/23.
So current order book is of 70 crores, sir. You have mentioned in your opening remarks.
Yes.
And can you provide the split between PSUs and export and the private players?
10 crore is the export out of 70. And we have some orders from PSU also.
That the breakup between PSU and the private players?
That we will have to check and get back to you.
And what is the executable period for it?
In the current year.
And it's the current year, the 9 months baki hai. So this 70 crore will get executed over the period of 9 months?
Till December.
Till December. So coming 6 months, it will get executed. The 70 crore.
Yeah. Yes.
Correct. Right, sir. I'll come in the queue, sir. Thank you for the answer, sir.
You're welcome.
Anybody else who wishes to ask a question, we have the option of raise hand. Surit, you can go ahead, unmute yourself and ask your question.
Yeah, hi. So is it fair to conclude that this quarter's margin compression is due to the fact that you've exported more in this quarter and not sold more in the domestic market? And as you go along with your plans, the margin will revert to your previous guidance of 20% plus? PAT margins 20% plus.
Kanan?
Should I answer?
Yeah, go ahead.
Yes. So Suryaji, that is right. But we have sold to private and export in this quarter, more to in this quarter, and we are hopeful that we will fall back into the margins which were before in the coming, not in the next quarter, but in the third and fourth quarter of this year.
And do you maintain your long-term guidance, that 500 to 600 crore number, which you've been mentioning for a few years out? Do you see a permanent reduction in margins for that also, or do you think that you can go back to the levels that they used to be at?
We feel that we can reach to that level, yes, but that was considering a few of the newer products that we were developing. There is a little bit time which is being taken for the approvals for those products. So it might get extended by 1 year or 2 years, but we are working on it to reach to that level.
Yes, yes. The answer is yes for that. Yes, by the time period which we have mentioned previously, we should reach to that levels.
Not only on the revenue, so I'm also asking, will you be able to maintain the margins also at 20 to 25% profit after tax margins at that revenue run rate of 500, 600 crores?
Yes, yes, we are hopeful of that.
Thank you.
We'll take the next question from Agastya. Agastya, you can unmute and ask.
Hi, am I audible?
Yes.
Thank you for the opportunity, sir. Actually, today's commentary was actually very enlightening. There were many things that I did not understand about the nature of your price setting, and so one question. So, is hedging not possible at all in a normal business cycle for you guys?
We are actually in talks with professionals to see how we can do hedging for our steel products right now.
So if you were to do hedging, let's say कितना क्वार्टर का आप व्यू लेके चलेंगे, कुछ आपने सोचा होगा ना कि and how much is the quantum, what kind of steel do you want, like what is the tonnage that you need to hedge so that you are in a comfortable situation? Just I'm trying to understand the scale of the hedging needed.
That depends on our requirement, no?
Yeah, so I'm talking about, let's say, how whatever you have done in terms of revenue this quarter, अगर आपको ये पूरा hedge करना पड़ा, because value addition is quite a lot in your company, right? ऐसा थोड़ी ना कि आप steel लेके steel बेच रहे हैं. You're not a trader. You're adding a lot of value, and your equipment and your margins reflect that, right? Your steady state margins. So I'm just wondering, what kind of steel quantum are you dealing with every year or in a quarter? कितना extent तक आपको hedge करना पड़ेगा?
Tentatively 50% of the orders to be executed.
Yes, sir. Sir, can you give a tonnage, an absolute number? Let's say, for example, 1,000 tons, 10,000 tons. एक tonnage का number कुछ रहेगा आपके पास?
Approximately, let me answer that. About 10,000 tons.
About 10,000 tons, right? That is what I thought, around 10,000 tons. Okay. So second question is, you said that last year drilling was not enough. Like whatever was budgeted could not be done by ONGC and Oil India. So when did the drilling activity start this year? And you said that another 1 quarter, a very similar thing will happen. But given whatever the backlog was, they will be able to clear all that backlog in terms of drilling, and normal demand will immediately pick up. Yeah, there will be again a step-by-step increase in demand before they go back to the old trends.
See, the inventory which they have, that they have till this second quarter, and they will require newer material for the wells that they are going to drill after that. So we are anticipating that in the next coming third and fourth quarter, the quantum will be the same as which they were procuring in the last earlier years.
Okay. So it's just a deferment.
Yeah.
The activity levels have not dropped.
No.
And
actually,
they will
the activity levels, we are getting to know that they are probably going to increase also.
Right. मतलब पुराना trend जो उनका चल रहा था वैसे it will revert back to that old trend.
Yes.
And Pramodji, just a clarification, when you said 10,000 tons, that was for a quarter? Yeah, that is for an year.
No, that is for the whole year.
That is for the whole year. Okay. Thank you very much, sir. Thank you very much, sir.
Thanks, Agastya. So one question which I would like to ask is, if you can give us some direction on what is happening on the international business side? Where are we in terms of all the tie-ups that we did with the marketing sales agents?
Initially we started with Vietnam, Egypt, and Libya. So we are getting repeated orders from Egypt and Vietnam, and Libya actually, because of COVID till last month only, they had closed all operations which they started. So we are discussing to go in Libya also with our sales representative over there. With respect to UAE and Kuwait, we are in the process of getting our products um, approved, and we do have a few smaller orders which we are executing, but eventually in the next, I think, 6 months we should see an influx of orders from there, that side also. Plus we are getting ourselves registered into newer regions also, and finding more sales representatives who can sell our products there.
So of our order book today, how much is domestic business and how much of that is PSU?
I need to check and give, but we, out of 70 crores, around 10 crores is exports, and around 60 crores is domestic, which is both PSU and private. That I need to check how much it is. So what is what?
Okay. Anybody else who wishes to ask a question? May kindly raise hand, or you may use the option of unmute.
Yeah, hi, VP Rajesh here.
Yes.
With respect to the international clients, what kind of demand are you seeing, given that the oil prices have corrected in the last 3-4 months?
See, I think I think the oil prices at anything above $50 a barrel, it's a good market for our prices, because most of the world, let's say Middle East, the cost of taking out crude oil is very less. It's like around $15 to $20. So anything above that is a profit for them. And for even in, let's say, Vietnam or Russia or South America, the cost is not more than $45 to $50 a barrel. So if the oil prices are at 70, 80, we'll see that this trend is going to be there, and the activity will be good for at least the next 2-3 years that we see.
Okay, thank you. And the second question is that when do you think you can hit this 500 crore revenue target that we were just talking about earlier?
Around, sir, will you like to answer this?
Yeah, I would say around 25, 26 years.
So 4 years, so in 3 years, basically, you are
Yes.
saying that we can get to 500.
Yes, please.
And in that, how much will be international versus domestic?
My approximation is that 20% should be export and 80% should be domestic, and in domestic private players as well as PSUs.
Right. Okay. All right. Thank you. That's all I had for now.
Okay, you're welcome.
Thanks, VP. We'll take the next question from Saket.
Yeah, yes, sir. Sir, if you could give us the breakup of the product profile in revenue terms. You mentioned about connectors and others. So with the ascending order, if you could give for the last year, which are the products that contribute to the revenue profile, and total number of products, sir?
We have 5 major products, which is connectors, casing pipe with connectors, winches, stabilizers, and gas lift equipment. So there are various sub products which are there, various sizes, various types in that. And the more profitable products which are there are the connectors and winches, and then after that will come the casing pipes and the stabilizers and the gas lift equipment which is there.
Sir, for casing, yes, sir, please. आप कुछ बोल रहे थे.
No, I was asking that. I hope I answered your question.
Sir, for casing pipes, we do the job work part. We are not manufacturing pipes, so we are sourcing pipes and doing some job work there, and then giving to our clients. What is the scope of work?
No, actually, when I say casing pipe, it is casing pipe with connectors. It is that is the main product which is there. So the casing pipe is there's a bare pipe which we procure. We manufacture the connectors ourselves, and then we have to weld it. After welding, it becomes one product. And that is the main product which is there. So it's not job work actually. It's a complete fabrication and manufacturing of that complete product which is there.
So we include, I think, so MSL also, Maharashtra Seamless, in our client profile. So I think so. In that case, we are just when we are putting this fabrication work for connectors to their casing pipe. This is how our scope of work involves.
See, the bare pipe is, people cannot sell the bare pipe itself.
Correct.
You have to weld the connector to it, then only it can be sold.
Okay.
And that is also above 18-inch and above, the pipes which are there.
We procure the pipe from not only MSL, but Jindal, Welspun, and Man Industries.
And then it is the selling happening to the PSUs. This is how the money. I just wanted to understand the ecosystem, how it works.
Yes, and then we sell it to the PSUs, the upstream, companies like ONGC, Oil India, Kane Oil, like that, Reliance.
And sir, if we have the breakup of the cost of raw materials in percentage terms, what are the key raw materials?
Key raw materials are basically connectors and pipes. For connectors, the key raw material is the forgings.
Sir, I mean to say the 33 crore line item for the expenses. What constitute this, the major components?
You mean for this quarter?
Yeah, for this quarter, for the year as a whole also you can provide, if not for one quarter.
Approximately the pipes constitute, 55% of the cost, and the connectors constitute 45%.
Okay. And so there is also an increase in the finance cost for this quarter. What explains
Temporarily, we have taken the loan from the banks.
Could you explain more further, sir?
Mehta, please explain why it is so.
Temporarily, we utilize our cash credit limit from bank. This is for some period. That's why their interest cost has increased. This is not a regular feature.
Okay, but what has led to this temporary withdrawal? I mean, what is the we have? I think so. We are net cash company.
Because our inventory level has increased. We are going for overseas market, so we have to keep the inventory.
Okay.
So therefore,
what is the value of inventory? Okay, please आप बताइए, मैं आप बोलूँ.
Can you repeat?
Sir, आप फिर से बोलिए. I have interrupted you. Sorry.
Actually, our inventory level has increased, so we have to utilize our cash credit facility from banks.
Kanal, can you explain that why, or otherwise then I will explain.
Please कह दीजिए.
Acha. Actually, like it has been explained, see, because we are trying to make a foray in export markets and private players, and usually they require their products to be delivered in a period of 4 to 6 weeks or maximum 2 months. And it takes us around 4 to 5 months to manufacture our products. That is why we have to keep a lot of our products in semi-finished stage so that we can finish that within the time period and supply it to them. And this is done not only by us, but most of the companies who are in the similar line of business. And so therefore, certain amount of funds were tied up in our inventory. That's what Mr. Mehta is trying to explain. And in this particular quarter, for certain orders, we had to utilize our cash credit limit, for certain period. That's why there were certain additional finance costs.
So what is the value of inventory as on 30th June? How much amount involved?
It's 121 CR.
Okay, and what is the cash balance as on June?
We have around 4 CR FDRs in hand.
Okay, sir. ठीक है, sir. Thank you.
You're welcome.
Thanks, Saket. We'll take the next question from Suraj.
Yeah, hi, sir. So following up to some previous question I asked in the Q4 call, you mentioned that the inquiry pipeline was very strong, and the benefit of that should be seen in Q1. So I was wondering if you're seeing any change in the demand environment in the last 3-4 months.
Actually, Suryaji, what has happened is that there were 3-4 projects in which we were expecting an order, but because of global inflation, those projects have been postponed right now, which is going to, which we are hopeful will come in the next quarters. So that is something that we have seen because of the global inflation.
And
we had, sorry.
Plus the PSUs also. You can explain that.
And plus also, as I stated earlier, that the PSUs also, we were hoping that their procurement will start from the April month for this year, but that also got deferred because of the inventory which they have.
Okay, so is it fair to say, again, I think you mentioned this earlier, but it's just that it's not a cancellation of the order of the order pipeline, or it's not that there's weakness, it's just a postponement?
Yes.
And you had also mentioned in the previous quarter that about 15 crores of revenue has got deferred from Q4 to Q1. So this 37 crores has been reported, that includes 15 crores which is rolled over. So is there another reason why execution in this quarter has been so low?
Sorry, can you please repeat your question?
Yeah, in the previous quarter's call, you had mentioned that about 15 crores of revenue has got deferred from Q4 to Q1, which means from last year to this year.
Yes.
So if that is the case, then this quarter, the total revenue was 37 crores, which means 15 crores is just rolled over from the previous quarter, which means new quarter execution, current quarter execution has been quite low at 22 crores.
Kana, should I?
Yes, please answer kar dijiye.
I think when it was mentioned in the last quarter that 15 crores will be rolled over from last quarter to this quarter, that may be there because of, we have to really check on that, please. But primarily, the amount which has been executed is what is indicated there. So, but the major impact has come because the oil companies have stopped their purchases in these 2 quarters, and that is why we are having such a and then we have to sell to private customers or to exports at a high cost inventory at lower prices. That is why our profit margins are less.
Okay, and the last question is that you had earlier guided that FY23 should also be a 250 crores kind of revenue. Is that guidance still in place, or would you like to revise that?
For the whole year, this year?
Yes, for the current financial year.
For the current financial. Yeah, actually, because of this delay in the procurement by the PSUs, I think we have revised our top line. Colonel, what is that?
Because of that, and plus we were expecting clearances of 2 of our products which we had developed. We had added that also in the top line, which we had quoted earlier, which is going to take which should probably be added up in the next year. So now the current revised is around 20 to 25% increase in the CAGR. We will see.
So that will come around 200 crores, I think 205.
Okay, thank you.
You're welcome.
Thanks, Surit. We'll take the next question from Raja. Raja, can unmute and ask. We'll move forward. Ria, sorry,
Yeah.
Raja, you can go ahead.
Can you hear me?
Yes, yes. Mr. Raja.
Okay, so my question is, currently, what is the breakup between private and public sector customers for us?
Right now, the overall market is around about 250 crores is for oil PSUs, and around 150 crores is for private.
Okay, and in our revenue, what is the share roughly?
We have around 50 to 60% market share for the oil PSUs. For the private, it is increasing.
No, I mean, in the last Q3 call, I think we said that in PSU, roughly 6,000 to 7,000 is the order book for connectors, and we own 100% of that. I mean, we supply 100% of that. Isn't that right?
We can supply 100% because we have the capacity to supply or whatever is the requirement in India. Yes.
Okay. No, I'm saying, say like last year, our revenue was 175 crores. 65% of that we said is casing and connectors, right? So that's roughly. So out of 125 crores, I think we gave somewhere that, okay, 60 crores is the connectors market and the rest 65 crores can be attributed to the pipes. Is that figure correct, or I have some mistake in the understanding?
Sir, will you like to answer?
Nick, let me answer that. I think those numbers are a little bit. I think the connectors were, and I'm just telling from my memory,
Sure.
were around 35 to 40 crores, and balance was casing pipes. You know, and then there were wireline winches and stabilizers and gas tube valves. The other products were also sold, which must be around 25 to 30%.
Okay.
So I think that should answer your question. That connectors were around 35 to 40 crores.
Okay. Okay, sir. Actually, what I was driving at is when we look at export market, will it be economically feasible to send the pipes and the connectors, or are we looking to mainly sell the connectors in the export market? That was the question I was actually coming to.
Right. Actually, it depends upon the customer. Certain customers ask for only connectors, and they have the facility to procure the pipes and weld it in their country. But some customers don't have that, so they buy directly the pipes. So we sell both.
Okay. Okay. And sir, talking from a customer point of view, so if I'm into these oil things, then the cost of these connectors and pipes would be very minuscule compared to the overall cost of running the operations, right? So my question is, what would be the point for me to consider if I'm trying to change the vendor for this critical components, which may not be a very huge cost difference from wherever I'm buying it, like?
We are see the competitors that we have in this product line. They are either from US or UK, right? And the cost difference will be around about 15 to 20%.
Right.
again from us to there, because their overheads are very high.
Correct.
And labor is also very high over there.
Correct.
So when we are selling to them, so it will be feasible for them to buy from us with cost point of view. Plus, secondarily, we would the delivery, because these are all big giants and they have back-to-back orders, and their delivery is long delivery periods they have given. So if there is any person whose project is there and they want to do their project fast, then we can get that order from them by reducing the delivery period.
Right. So prompt delivery could be one of the reasons.
Yes,
but this
so that is why
cost
we have kept inventory and stock, so that if anybody is there, then we can give that material to them in lesser time.
Right. Right. But this cost part, this 15-20% cost differential, when the customer looks at it from his overall cost of running the operations point of view, this may not make a huge difference. Is that understanding right? I mean, it may not be even in decimal percentage for his overall.
It depends, because see, it is divided into two parts. The cost is divided into two parts. One is the capex cost and one is the opex cost of doing it. So when we look at the overall cost, yes, of drilling a well, it will be around about 4 to 5% will be the range of which the pipes are used, which we manufacture and supply. So any place, and a lot of these people, there are integrated projects where the service companies come in. So wherever they will save cost, they will try to do that.
Right, right. Thank you. Thank you so much.
We take the next question from Riya Mehta. Riya, you can unmute and ask your question.
Hello.
Hi.
Yeah, so first question would be in regards to the raw material prices. So we're looking at commodity softening overall. So are we seeing any decrease in the prices of the pipes from our vendors? And do we benefit it the other way around, like because of our business model where we procure the inventory for a longer period of time and our execution cycle is faster? So do we benefit the other way around when the commodity prices reduce?
Should I answer that?
Yes, please go ahead.
Yes, ma'am. It happens sometimes that it benefits to us if the things go other way around.
Okay. Are we seeing anything like that happening?
It could happen, that since the prices keeps on going down, sometimes it happens that we get an order at a particular, when the steel prices are higher, so we also quote a higher price, but later on when the prices start softening, so our prices are the same to the oil PSUs, but we can buy it at a cheaper price. Yes.
Are we seeing something like this happening in the current or the next quarter with the softening of the commodity prices?
I wouldn't say in the next quarter, but during the year, it could happen. Yes, please.
Okay. And my second question would be the order book. Could you give us the breakup of the product wise? Like what part would be connectors, what would be casing pipes, and the other three equipments?
Well, we'll have to check and then we can send you the information.
Even in a percentage wise is also fine. I just want a broad sense.
Out of 70 crores, I think around 30 to 35 crores will be casing pipes, and around 20 crores is wireline winches. Huh?
Yes.
And the balance is stabilizers and gasket valves.
Okay. Okay. I think that's it from my side. Thank you.
Okay, you're welcome.
Thank you, sir. I think that brings us to the end of the question and answers. So would you like to give any closing comment before we end this conference call?
Sir, will you like to go ahead?
Yeah. Well, I wish to thank everybody for participating in this conference call. And I would just like to mention that this particular quarter is not the end of the line. You know, it happens in the business. Sometimes you lose, sometimes you win. And so, you know, this has happened, but we are looking for a very good future in the later on during this year and in the years coming by. We are developing some new products. We are making tie-ups in the international markets, and even in Indian oil PSUs also, we have checked and seen that their drilling programs are now becoming bigger and bigger. So combining all these things, we feel that United Drilling has a good future, and we should do better in the quarters and years coming. Thank you very much.
Thank you so much, sir. And I thank all the participants for joining on the call. And I would like to thank the management for giving us the time for the call. This brings us to the end of the conference call. Thank you so much.
Thank you. Thank you.